has already told you about the debt. So, as a backdrop, I will just say that we had global financial regulatory reforms after the global financial crisis. And that's a very broad sweep. They have touched institution, markets, market practices, everything. And as we go now, we face the pandemic, and my personal view is these reforms have done a lot to sort of bulwark against those spillovers and crisis spreading across the globe. But I leave that to the panel to give their observations on that. So let's sort of kick off the discussion, and let me open with Ananth, because Ananth has actually a very widespread experience. He was in the banking treasury, and he was also an academic and is now overseeing the equities market. I'm sure with a wide lens, maybe bifocal, also working about basically because you want market to deepen, market to sort of develop. So he's doing a fine balancing act between strict regulation and the development. So let me sort of ask you that basically, like, what are the key lessons learned from the global financial crisis? And are we safe enough today that the spillovers won't really affect the markets that much? The markets will remain stable, both domestically in India and from the global viewpoint, how this will pan out.
Thanks a lot, Mridul, and congratulations to you, by the way, and to IIM, Kozhikode, and NSE for putting this together. I think the morning session was absolutely fabulous. You asked for an honest and open conversation. Is the press here, just to confirm?
Yes, I'm afraid it is there. They're not going to leave you.
Okay, so that's fine.
But I will urge them to report responsibly.
Okay. No, the opening question is harmless enough. Lessons from the global financial crisis. Look, I think one key takeaway, at least from my narrow, limited perspective, is interconnectedness of the financial architecture, which was kind of underlined during the global financial crisis. So if you look at the way it apparently started, it started off with the subprime crisis, which was, you can argue, a niche part of the US economy to start with. That then transmitted to a few investment banks which were impacted directly.
Sorry to just intervene. So it was not the financial innovations, but the institutional regulation was weak?
No, it was a combination of everything, I think. So the domino effect really from subprime crisis hitting a few investment banks, the transmission from that layer to the larger financial sector happened through multiple ways, right? So you had very innovative derivatives which kind of spread the risks in ways which people didn't understand fully. You had leverage which had been built up in the system, often unrecognized, and therefore that added to the problems. And then you had this international connect. These derivatives and these capital flows were across borders, right? It was not just to one particular jurisdiction. So you had what started off as a niche problem hitting a wider set of financial sector entities. That in turn impacted the real economy, the stock markets, global flows, and take the case of India. You could argue that we were not really in the thick of any of these things, neither subprime lending, nor exotic derivatives beyond a very small sliver, nor real exposure to monoline insurers and stuff like that. And yet our real economy and our financial economy was impacted in a big way. I think the point to note is there is interconnectedness. We are a giant set of dominoes across the globe, and that's a good thing. We need this interconnectedness because that's the way in which the virtuous cycle spreads as well, when you have growth and capital formation and savings and investments all coming together. And on the flip side, it just underlines that if one of the dominoes starts to wobble or fall, you can't really predict how this can spread across the entire landscape, the entire financial sector landscape. Now, I think a lot of good work has happened since then. Obviously, we've learned a lot of lessons. So we've had tremendous, improvements in banking regulation. Some would argue maybe that it's too much of regulation, but the fact is the capital buffers have been increased dramatically. There's been a huge amount of regulation as far as removing the opacity is concerned on derivatives, getting them to come on to exchange platforms, putting huge margin requirements on over-the-counter derivatives, making sure that clearing corporations are strengthened adequately. So there's been, and then every regulator, whether it's the central banks, whether it's the securities commissioners, they've all done their bits to strengthen their parts of the forts. But I think the reality remains that we are a bunch of dominoes everywhere. Interconnected is there. Now, Ayyappan is here who writes the financial stability report, and they do a section on interconnectedness within the Indian sector, for instance. But the reality is it's a lot bigger than that. It covers a huge amount of players which you're not even aware of. Just a small example of this. The last year when Silicon Valley Bank kind of wobbled, over that weekend I remember, we were looking around to see what could be the impact on India. And the point was Silicon Valley Bank was a favorite amongst private equity players. So there was a sense that maybe there would be, both from private equity investors who have come into India and from those who have received funding from such private equity, they could be having exposures into Silicon Valley Bank. And I can guarantee you many people wouldn't have heard of Silicon Valley Bank in India before that event actually happened. So the point is, we don't know the unknown unknowns, even today. Yes, each of the forts have been strengthened dramatically, so that if the domino effect does happen, at least your domino stands straight. That's the kind of effort that's gone in. Some of the interconnectedness in terms of OTC derivatives, for instance, or cross-border collaboration, there's been a lot of good work on ensuring that those parts are strengthened. But we don't know what we don't know. And as a regulator wearing a regulatory hat right now, my job is to worry.
So thank you. It's very interesting. One, you pointed out that we don't fully capture the network. So that's very important. The second was the Silicon Valley Bank. Silicon Valley Bank was not a GSIB. Yep. So, and yet it had the potential to cause spillovers from systemic crisis. If Fed wouldn't have acted fast, we could have seen a wider banking crisis. Let me turn to Ashu, because GSIBs have caused a lot of pressure on the capital requirements which banks need to raise, not just for GSIBs, but then DSIBs have to raise more capital also and stuff. So do you think these reforms have gone overboard in terms of capital requirement, or is it something which was needed because we want to ensure more stable environment? So
Mridul, I think Ananth summarized it very well. I think GFC clearly exposed that a lot of this reform was required. So I think on the whole, while we can quibble about specific elements and what it may have done in terms of some of the risk-taking, private credit formation, market making having gone outside the banking system into the shadow banking system or the private equity world, on the whole, I think the regulators, did a pretty good job of strengthening the banking system, no question about it.
So that's coming a thumbs up from the bank, which actually got the largest support from the top, like 34 billion.
I thought I'd forgotten that information, but thank you for reminding me.
6 billion. Okay, fair point. Sorry,
but
go ahead.
So I think the point on the GSIB, and again, in the Indian context as well, I'll mention that, all the foreign banks who operate in India, we have to have that extra supplement. So for me, the minimum capital I need to operate is 15% as opposed to the 11.5%, and I think Hitendra probably has slightly lower because his GSIB is lower. But, does it really impact our ability to operate in this market profitability and add value to our customers? I'd say no. Okay. One, because I think most private banks operate around 18-19% cushion in any case, so I think, and there are enough opportunities in the Indian market for us to, despite that little bit of an uneven playing field, not let it become a drag on what we want to do in the business perspective.
Yeah, thank you. By the way, I may add that Treasury made $12 billion out of the support they gave, if I have my numbers correctly recalling. But Hitendra, would you like to add anything?
Yeah, no, I want to say one thing first. It's a great privilege to be in this auditorium. I had the privilege of meeting Dr. R.H. Patil when I was a student and studying exactly what many of people in the audience are doing. I never thought then that I had been in an auditorium named after him and addressing students. So it's great to be here. I think, just in terms of whether the regulations have gone overboard, underboard, you'll never get this right? I mean, you as a regulated entity that is being asked to keep more capital, that means your returns go lower, you'll feel that. But at the same time, having a 10, 20, 30 year run of no run on any bank, you know that that's giving you a lot of benefit. But maybe so what's been the change pre-financial crisis to now, right? So one is, for every rupee of asset, you are keeping more capital than you were earlier. The rupee of assets is being defined much more properly. So for some assets, you require more capital. For some assets, you require less capital. So there's a bit more science to this rather than a generic every rupee sets aside the same amount of capital. That's principally one. Types of capital were changed. Earlier was capital as we traditionally understand it. We are in National Stock Exchange, so we understand what capital is, right? The equity capital. But now they have allowed those loss-absorbing capital. And the principle everywhere was, before any depositor gets hurt, let's have a series of shareholders or other investors who can be impacted first, right? And the third significant change, apart from what Ananth mentioned in terms of central counterparty and bringing the derivatives mark to market and other things much more transparently, was on liquidity. And I think that's possibly underappreciated, because now the amount of liquidity that banks receive as deposits, but we can't lend out, right? That whether it's through LCR, what in India was historically SLR, some form of LCR, but now the idea is that in a stress run also you should always have liquidity, so that any withdrawal of deposits can be met. But to sort of the speed at which money moves now, okay, SVB is a classic example. Over the weekend, Twitter, everyone calls it a Twitter-led downfall of a bank. And we have had similar cases in India. I mean, WhatsApp, it starts before you know it, you can keep as much liquidity as you want, but you can never keep 100% of your liquidity available, because that's not a business, right? Right now we are doing roughly 1 month of stressed outflows are kept. But so that's the other thing, that on liquidity, the norms have been tightened quite considerably. It's difficult to imagine for large banks now to have a liquidity run in terms of them not being able to meet the liquidity outflows. But given the technology and given that we work, India works 24/7, you can have 10,000 crores moved in the middle of the night. No, so things like that. So yes, it's a safer financial system. Yes, we have more capital. Yes, we have more liquidity. Yes, we have more well-defined assets or RWAs or things like that. But Credit Suisse tells you, Credit Suisse capital adequacy ratio at the time of its downfall was around 15%. Credit Suisse LCR was 140 odd percent, right? So, and yet it fell, right? So it's a confidence I don't think regulations can fix. That's the issue, right? How do you fix confidence as a regulation? So it was a crisis of confidence at SVB and CS. So lessons from there, I'm sure regulators are working through on what next to be done.
So that's interesting. I think a very important perspective. He seems to be having the view that probably we are going not even with the LCR numbers we have, we could still face crisis. So what's your view, Neeraj? I mean, we in India have the double whammy of SLR and LCR, and then NFSR also comes in for a 1-year duration. So RBI has already tried to align this. So in one sense, we are a jurisdiction which should be happy that we had a LCR-like instrument even before the global financial crisis. So it has a meaning. But do you think some more calibration is needed there, or is it the right ratios we have?
So, thank you first of all for inviting me here. You're right to say that LCR was introduced in the beginning and we had a parallel regime of SLR in India. over a period of time, SLR has been subsumed in some senses into LCR from a reckoning perspective. But SLR is still there. I'll give an example. If you're